You know, when you watch like a high-end computer simulation of a car engine running, it's just totally flawless. You're looking at this infinite digital energy. There's zero friction, there's no heat loss, no wear and tear. It's just a perfect closed system.
Yeah, but then you step away from the screen, right? You walk out to your actual garage, pop the hood of a real car, and suddenly you're dealing with grease.
Right. Well, you have a very finite amount of fuel in the tank, and you've got rubber belts that can just snap at the worst possible moment.
It's that digital ideal just crashing headfirst into physical reality.
Yeah.
And I mean, it's rarely a smooth transition.
And that contrast is basically the absolute defining theme of the global markets today. Welcome in, everyone, to NovaStream. We are so glad you're tuning in with us right now. You already know NovaStream is your 24/7 home on YouTube for tracking the live crypto markets.
Yeah, we've got those sparkline charts running continuously for you.
Right, for BTC, ETH, SOL, all the major altcoins, along with your global financial indices from the S&P 500 and the NASDAQ to your Forex pairs. Plus, our auto-curated breaking news feed keeping you updated the absolute second a headline drops. Today, we're not just reading the ticker, though. We are jumping straight into our highlights of the day.
And we are tracking a massive interconnected news cycle today, really defined by that split you mentioned between digital perfection and physical friction.
So let's start with the digital euphoria, because the primary catalyst driving the NASDAQ and the S&P 500 today is it's a massive shift in the AI hardware landscape. For the last year, NVIDIA was basically the only story in town, right?
Pretty much, yeah.
They were the giant server farm chips. But today, NVIDIA announced something called RTX Spark. This is an ARM-based CPU they built in partnership with Microsoft, specifically designed to power AI agents on consumer laptops and mini PCs.
Which is huge.
Right. And the second this hardware dropped, it ignited a massive software rally. I mean, ServiceNow, Asana, Adobe, they all just jumped. So what is the actual mechanical connection there?
Well, the market is recognizing a major shift in the timeline here. RTX Spark represents a move toward edge computing. Up until now, if you wanted to use a powerful AI, your laptop had to send a request to a massive, centralized cloud server.
Okay.
You'd wait for the processing and then receive the answer back. But that cloud processing is just cripplingly expensive for software companies to maintain at scale.
Oh, because they're paying for all that back-end compute every time you click a button.
Precisely. By moving the processing power, the actual brain, locally onto your personal laptop via RTX Spark, software companies like Adobe can deploy vastly more complex AI agents without absorbing those massive cloud computing costs.
Wow. So their profit margins suddenly look much, much wider.
Yes. The infrastructure is maturing to the point of utility.
Okay, let's unpack this with a different lens. For a while, we've used the whole gold rush analogy for AI, but I think a better way to look at it is like building a massive new highway system. NVIDIA has spent the last year pouring billions of tons of asphalt, right? The raw infrastructure.
Right, the roads.
But looking at these software stocks jumping today, it feels like we're finally seeing the actual cars driving on the highway. We're seeing real consumer applications.
Spot on. And institutional money is clearly signaling that they believe this utility is real, it's not just hype.
Which brings us to Microsoft. Their shares just decisively broke above their 200-day moving average today. Now, for anyone watching the stream who isn't, a full-time technical analyst staring at charts all day, why does that specific metric carry so much weight?
The 200-day moving average is essentially the ultimate polygraph test for a stock's underlying momentum.
A polygraph test, okay.
Yeah, because it mathematically smooths out all the daily noise. The intraday panic, the momentary hype cycles, all that gets filtered out. But more importantly, it's not just a psychological line in the sand. It's a mechanical trigger.
Wait, mechanical how? Like algorithm?
Exactly. Many institutional trading algorithms and quant funds have automated rules directly tied to the 200-day moving average. When a mega-cap company like Microsoft breaks above it, it triggers automated buy programs across Wall Street.
Wow, so it kind of forces their hand.
It acts as a massive technical green light for the smart money, basically confirming that the bullish trend is durable.
And if you want proof of that durability on the hardware side, just look at Hewlett-Packard Enterprise today. HPE delivered a blockbuster earnings beat. I mean, shares surged 28% in after-hours trading. Their total revenue is up 40% to $10.7 billion. But what's driving that 28% stock surge specifically? Because it wasn't just general sales, was it?
No, it wasn't. It was their networking segment revenue. It absolutely soared 148.2% to $2.7 billion.
Wait, 148% growth in just networking?
Yes. And they even raised their 2026 fiscal guidance to 29 to 33% growth, based almost entirely on this division.
So the GPUs are essentially bottlenecked without this specific plumbing.
That is the hidden reality of an AI data center right there. Everyone focuses on the glamorous processor chips, right? The GPUs.
Right, brains.
But an AI model is trained by having thousands of these chips talk to each other simultaneously in parallel. If the network connecting them, the cables, the switches, the routers, if that's slow, those incredibly expensive NVIDIA chips just sit idle waiting for data.
Oh, man. So that 148% surge in HPE's networking revenue tells us that corporations are just frantically ripping out their old data pipelines.
Yeah, they're installing massive high-speed networks to ensure their AI chips can actually run at full capacity.
Which makes perfect sense of a quote we got today. NVIDIA CEO Jensen Huang was at the Computex trade show and publicly stated that Marvell Technology could be the next trillion-dollar company, specifically because of their role in this AI infrastructure.
Because Marvell makes those critical networking components.
Right, and their stock immediately surged on the comment.
It validates the entire supply chain. It's not just about the brain anymore. It's about the nervous system connecting the brains.
But here's where it gets really interesting and honestly a little concerning to me. This massive infrastructure build out, the asphalt, the traffic grids, the nervous system, it is not free.
Far from it.
Alphabet just asked its shareholders to foot an $80 billion bill for AI expansion through an equity offering. The shares slipped about 0.7% on the news. But what really caught everyone's eye is that Alphabet is selling $10 billion of this stock to Berkshire Hathaway at a deep 6.5% discount.
Yeah, that turned some heads.
Now, I really have to push back on this strategy. Alphabet generated $174 billion in operating cash flow over the last 12 months. They're sitting on over $126 billion in cash right now.
They are.
So why dilute your own shareholder value and give Warren Buffett a discount to raise more money when you have a literal mountain of cash in the vault?
It really comes down to the sheer scale of the capital expenditure, or CapEx, that's going to be required over the next 3 years, combined with risk management.
Okay, risk management how?
Well, Alphabet is telegraphing that building out global AI data centers is going to be astronomically expensive. We are talking projections of 180 to 190 billion in CapEx for this year alone across the tech giants.
Wow, so even 126 billion in cash doesn't cover it.
It covers a lot of it, sure, but if Alphabet drains its entire cash reserve to zero just to build server farms, they leave themselves entirely defenseless against a sudden macroeconomic shock.
Like a recession or a supply chain collapse.
Exactly. By issuing equity now, even taking a 6.5% haircut to secure a blue-chip anchor investor like Berkshire Hathaway, they secure the guaranteed runway they need for global compute expansion without completely emptying their emergency fund.
So it's a defensive move disguised as aggressive expansion.
You could definitely say that.
But looking at the broader market, I am not seeing much defense anywhere else. Investors are just piling into bullish call options at a staggering rate right now. The put-call ratio just plunged to 0.452. Let's break the mechanics of that down because that's a massive red flag, isn't it?
It is a historical warning siren, quite frankly. A call option is a bet that a stock will go up. A put option is essentially insurance. It's a bet that the stock will go down, which protects your portfolio if the market crashes.
Okay.
A ratio of 0.452 means that demand for optimistic calls is currently more than double the demand for protective puts.
That is wild. We haven't seen this level of froth since the peaks right before the 2022 bear market. It feels like investors aren't just ignoring risk, they're actively throwing out their insurance policies. It's like thousands of people canceling their homeowner's insurance simultaneously just because it hasn't rained in a month.
Fear of missing out, or FOMO, has completely overridden risk management out there. The entire market is universally positioned for the upside.
And the mechanical danger there is what?
The danger is that when everyone is leaning in one direction, any unexpected piece of bad news forces massive panicked unwinding of those positions, which rapidly accelerates a crash. But the deeper, more nuanced metric flashing warning signs right now is actually the VIX-EQ indicator.
Wait, how does that differ from the standard VIX that everyone watches on the feed?
So the standard VIX measures volatility for the entire S&P 500 index. Right now it's incredibly low. The surface of the market looks very calm and steady, but an index is just an average.
Right.
If half the stocks are surging and half are collapsing, the average still looks flat. The VIX-EQ measures single stock volatility, so how violently individual companies are swinging, and that metric is currently spiking to a one-year high.
Oh, wow.
Yeah, we are seeing a massive historic divergence between the calm index and the chaotic underlying stocks.
So the mega cap tech stocks, the AI giants we just talked about, are rallying so hard that their mathematical weight is pulling the whole index up, completely masking the fact that traditional sectors underneath are just churning violently.
It is the absolute definition of market dispersion. We're in an extremely top-heavy market right now. A few colossal pillars are holding up the entire roof. Historically, when those pillars start to crack, the resulting correction is severe.
And the competition among those few massive pillars is getting really fierce. I mean, it's shifting from product launch events to Wall Street IPOs and federal courtrooms. Anthropic just confidentially filed for an IPO, officially beating their main rival, OpenAI, to the punch.
They did, yeah.
But OpenAI has a much bigger problem on its hands today than just being second to the IPO window.
We are seeing a major legal escalation out of Florida today.
We are. Florida Attorney General James Ithmeyer has filed an 83-page civil lawsuit against OpenAI and its CEO, Sam Altman. Now, just to be absolutely clear for our NovaStream audience, we are purely reporting on the contents of the legal filing today.
Right, no sides being taken here.
Yeah, we are not taking a stance on the politics or the validity of the claims. We are just looking at the facts of the suit as they exist in the document. And the state's allegations are severe. The filing claims OpenAI has purposefully foregone safety to gain a competitive advantage in the AI market, putting children at risk. Crucially, the suit is seeking to hold Sam Altman personally liable for his conduct as chief executive.
The request for personal liability is the really significant variable here for the markets. It fundamentally changes the risk calculus for any executive leading a frontier AI model.
How does this legal vulnerability mechanically translate into a financial disadvantage in the AI arms race, though, especially with Anthropic now heading to the public markets?
It all comes down to how institutional asset managers price risk. If you're a major fund looking to invest billions into OpenAI, a lawsuit claiming a company purposefully bypassed safety protocols and targeting the CEO personally creates massive institutional hesitation.
Because of the unknowns.
Right. You have to factor the potential for massive fines, forced structural changes, or even leadership removal into your valuation. It acts as an anchor on their valuation, whereas Anthropic can just pitch a much cleaner narrative to IPO investors.
Compare that regulatory headache to the absolute supreme confidence we are seeing over at SpaceX. They are prepping for their own massive public debut. They're targeting a mind-bending $1.8 trillion valuation, looking to raise $75 billion.
It's staggering.
But the way they've structured this IPO is really unique. They are reserving 5% of their IPO shares for staff, friends, and family, completely free of traditional lockup restrictions. However, 60% of the pre-IPO shares, which includes Elon Musk's holdings, are locked up for a full year. Walk us through the mechanics of a lockup and why this specific split matters.
Sure. So a lockup period is a standard IPO mechanism designed to prevent early investors and employees from immediately dumping all their shares on day one and crashing the stock price.
Right, it restricts the supply.
Exactly. By waiving the lockup for 5% of the shares, SpaceX is essentially daring the market. They're signaling that buyer demand for SpaceX is so ravenous that it will easily swallow that initial 5% supply without the price dropping at all.
Wow, okay. And locking up the 60%.
That creates extreme scarcity. Musk and the major insiders are keeping the vast majority of the equity completely off the market for a year. High demand chasing a tightly restricted supply mathematically drives the initial share price upward. It's a highly engineered supply curve, basically designed to project invulnerability.
It is absolutely fascinating to watch these new tech titans engineer their market debuts, while traditional systems of power are completely scrambling to adapt. And, we are seeing that massive disruption play out in legacy media today, too.
Oh, definitely.
Over the weekend, Hollywood box office records were completely shattered by 2 horror films, Backrooms, and Obsession. But here's the kicker. These weren't cooked up on a major studio lot in Burbank. They were generated entirely out of Alphabet's YouTube and the online creator culture.
It represents an entirely new economic pipeline for film production and distribution.
Let's look at the economics of that for a second. A traditional studio spends maybe $100 million on physical sets, catering, union crews, location scouting. It's a massive physical logistical operation.
Oh, yeah.
These creators bypassed all of that. They use the exact AI rendering tools and software we discussed in segment 1 to generate these films on a laptop. They bypassed the studios, they bypassed the theater distribution networks, and they went straight to the consumer on YouTube.
It demonstrates the terrifying speed at which digital networks can route around established physical gatekeepers. A single creator with high-end processing power and a built-in audience can now compete with a multi-billion-dollar studio apparatus.
But, and this is where we build the bridge to our final story today, that single creator on a laptop is not rendering a feature-length film in a vacuum. To generate that video, their laptop have to ping those sprawling multi-acre data centers.
Yeah.
Those data centers require the HPE networking cables, the NVIDIA chips, and most importantly, they require immense, uninterrupted baseline electricity.
The digital economy is fundamentally tethered to the physical power grid. You simply cannot have infinite software without finite energy.
Which brings us right out of the frictionless digital ether and straight into a very harsh physical reality. Global energy security is currently flashing red. We are looking at a single geographical choke point threatening the entire system today.
It's a precarious situation.
Brent crude just rose 4.2% to $94.98 a barrel. WTI rose 5.5% to $92.16. Peace talks between the U.S. and Iran are faltering badly. We are seeing reports on the NovaStream feed today that the U.S. carried out strikes in Iran over the weekend, and Iran's Revolutionary Guards retaliated by striking an American airbase.
The geopolitical reality is asserting itself violently, and it all circles back to the vulnerability of the Strait of Hormuz.
For those tracking the global commodities on our feed, this one narrow waterway handles 14% of the entire pre-war global oil supply. Persian Gulf countries have already slashed their output by 14 million barrels a day. So the obvious question is, if the Strait of Hormuz actually closes, does this derail the entire bullish tech market narrative we just spent the last 15 minutes discussing?
It absolutely has the potential to derail it because it attacks the foundation of the physical economy. Those AI data centers, global shipping, consumer spending, all of it requires baseline energy stability. And what is deeply concerning to energy analysts and macroeconomists right now is the sheer lack of a buffer in the system.
Right, we're talking about the strategic petroleum reserves.
Yes. To blunt the impact of recent production cuts and keep gas prices somewhat manageable, the United States has been draining its strategic petroleum reserve by about 9 million barrels a week. Next week, those reserves will hit their lowest levels since 1983.
1983, that is over 40 years of inventory just wiped out.
It leaves the global market highly exposed. Neil Chapman, a senior vice president at ExxonMobil, was at a conference last week and bluntly stated that inventories are reaching unheard-of low levels. And here's the mechanical issue with low inventory. It introduces extreme price elasticity to the market.
Explain that elasticity. Why does low inventory make prices jump so violently?
Well, when you have a comfortable surplus in the tanks, a geopolitical skirmish might cause a small ripple in oil prices, but buyers know there is backup supply.
Right, there's a safety net.
Exactly. When the tanks are empty, it shifts from standard supply and demand into a total panic bidding war for the very last barrel available. You don't even need an actual physical blockade of the Strait of Hormuz to see oil shoot past $100 or $110 a barrel.
Wow.
The mere threat of it closing, combined with the panic of low inventories, will trigger a massive price shock all on its own.
And let's tie this whole macroeconomic loop together. If energy prices spike to $110 a barrel, inflation immediately resurges. If inflation resurges, the Federal Reserve's ability to cut interest rates completely vanishes.
Right.
And if interest rates stay high, the cost of capital to fund that $80 billion AI expansion Alphabet is planning suddenly becomes agonizingly expensive.
Everything is connected. The cost of money dictates the speed of innovation.
It brings us right back to that opening thought. The digital economy, the YouTube creators disrupting Hollywood studios with a laptop, the NVIDIA chips rendering vast AI models, the software stocks breaking their 200-day moving averages, it all feels infinite and frictionless. But it is fundamentally anchored to a highly vulnerable physical world, running on finite fuel, relying on physical shipping lanes.
You have infinite digital ambition colliding with finite physical constraints. That is the ultimate tension for anyone allocating capital in this environment.
Which leaves you, the listener, with a really fascinating question to ponder as you watch the tickers roll by on the stream today. In a world where AI can build complex software code and YouTube creators can bypass massive legacy Hollywood studios overnight, How much of our entire global economy still hinges entirely on physical, vulnerable choke points like the Strait of Hormuz? When push comes to shove, which reality will ultimately drive the future of the markets? The frictionless simulation or the rusty physical engine under the hood?
It's the defining question we'll be tracking all week.
We want to say a huge thank you to everyone tuning in for today's highlights of the day. Do not touch that dial because the NovaStream 24/7 stream rolls on. Keep your eyes on the live crypto sparklines, the global forex pairs, and the auto-curated breaking news feed right here on your screen. We will see you next time.